Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
I want to switch back to, we'll kind of stay with global trade here. Shawn Donnan joins us here, Bloomberg News senior economics writer. As President Trump widens the trade fight to include global taxes and regulation. Shawn, thanks so much for joining us here. What is the latest from this administration as it relates to global trade, taxes, regulation? It's a wide mix of topics.
It's a wide mix of topics. It's also a fast-moving topic, as you can appreciate, and your previous guest was talking about. Look, yesterday, President Trump announced a plan to come up with what he calls reciprocal tariffs, and that will apply to any country in the world. They're going to start by focusing on countries with which the U.S. has a large trade deficit or economies. So they're looking hard at the European Union, for example. But what was interesting about yesterday, and a real departure from what the U.S. has done for decades, is that they're going to try and calculate these reciprocal tariffs by looking not just at the tariffs that those other countries charge U.S. goods, but also at taxes, at what they call non-tariff barriers, which gets into things like regulation. And as they say in the order that President Trump signed yesterday, any policy that offers any kind of barrier to a U.S. good. As someone I was talking to yesterday pointed out, that could even mean taking on the metric system if you're talking about the EU and trying to find a tariff cost there. So it's a real broadening out of what Trump has had as his kind of central grievances on trade in the past. One big target is the European Union's use of a value-added tax, which is effectively a sales tax that all of its member countries operate. That's very different from what we have here in the U.S. We obviously don't have a national sales tax. We only have state-level sales taxes.
And none are as high as the VAT. So, I mean,
none are as high as the VAT. And the real gripe from the Trump administration is that European exporters get to claim back VAT when goods leave the European Union, and that U.S. exporters to the EU have to pay VAT when they arrive there. Now, tax experts say that's kind of a misreading of how things works. VAT, much as a sales tax in Maine or Maryland would be, is a tax on something that you buy in that place. And those U.S. goods that have to pay a VAT or those U.S. companies that have to pay a VAT when they sell in France, say, are selling alongside French goods that also have to pay a VAT. Anyone has to pay a VAT in Europe. So it's not quite the competitive disadvantage.
Right. It's a little different. I mean, if I order something from Maine, I don't pay Maine taxes on it, right? But well,
that's right, unless you buy it in Maine.
I feel like this was a concept of a plan, Shawn, more than really a plan. And I thought we were going to get he tweeted that it was a big day. This is the big day, right? And then he said, well, I've got a concept of a plan, and also we're not going to know until April 1st. Like, they still have to do studies. Didn't they study during the campaign? I mean, I know which countries have higher tariffs than we do on goods. All he has to do is get ChatGPT, right, or a Bloomberg, and he would get the numbers. Why does he need to study until April 1st? Is he serious about this?
Well, because that's the business of government, right? There's a process here. And if he's going to invoke some of the authorities that he wants to invoke to apply these tariffs, and they are going to defend it against potential lawsuits from companies and defend it to the public, they have to at least go through a process of doing an official study. You should point out that.
And what was the point of Project 2025? Didn't they already do these studies?
Project 2025 wasn't his thing, and we should also point out that his main economic officials, his main trade officials, although they were in the Oval Office yesterday, haven't actually been confirmed by the U.S. Senate yet,
right,
and that's Howard Lutnick, the Commerce Secretary, and incoming Commerce Secretary, and Jason Greer, his U.S. Trade Representative.
All right. All right, Shawn, we'll stay on top of this. I know you will as well here. Shawn Donnan, senior economics writer at Bloomberg News. He's down there in Washington, D.C.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
A couple of the big topics that get people's attention if you're writing a story. Put Meta and AI into the headline.
Oh, yeah.
You're going to get some readership.
By the way, did you know that AI in Chinese means love?
I did not.
Yeah. I guess the word for love in Chinese is AI. I don't know how you pronounce it, but that's how you spell it.
And where did you come across this piece of information?
David Inglis wrote about it on the Bloomberg Terminal.
Then it's got to be true. So let's check in here. Mandeep Singh, he's a senior technology analyst at Bloomberg Intelligence. Mandeep, you got a big name, a big company, a leader with deep pockets in Meta talking about AI-powered humanoid robots. What's your takeaway here?
I mean, right now it looks like everyone thinks that is the next big hardware opportunity, whether it's Apple and now Meta. They seem to be looking at that form factor. And actually, NVIDIA dropped in that hint back in January when they talked about a new chip for humanoid robots. They released a new chip at CES, and they actually released their own large language model for the humanoid form factor. So it's not a surprise that everyone else is also looking at that opportunity. And obviously you have Tesla, who already has Optimus as a product and has talked about it almost on all their earnings calls, recently.
Yeah, they seem a little late to the party to me, frankly.
Yeah, but they got so much money, though, dude.
You know, they go after Twitter with Threads. They go after OpenAI with whatever Meta's AI product is called. They go after Tesla with...
Well, Apple's shown you don't have to be first. You just have to be, cool and good and all that kind of stuff.
True.
So, Mandeep, is this something that the street's going to like because it's AI, or is this something the street's going to say, is this kind of like the metaverse, which we didn't really like? How do you think the street's going to react to this?
Yeah, I think in the case of Meta, I mean, there are question marks on their ability to design a good, compelling hardware. And look, Ray-Ban Meta glasses have been successful. But when you look at the overall margin profile for a company like Meta, I mean, ads is such a high margin business that hardware continues to be a drag on their overall margins. And the fact that they're losing almost $20 billion every year on Reality Labs makes you wonder if they add more hardware in the form of humanoids, it could mean bigger losses in that segment. So I'm not sure if that's the right strategy for Meta, given they've had so much success, with their apps, family of apps, and how good they have been in deploying AI across their apps. Why would you want to spend too much time on hardware? But I think Mark Zuckerberg's view has always been he wants to control the ecosystem from the hardware and have that vertical integration, and that's why they're doing it.
Well, Meta stock, just to give you a sense, up 1% today, up 25% year to date, and up 55% on a trailing 12-month basis. So the market likes what's happening at Meta.
Yeah, they're killing it, but they don't control the ecosystem, right? I mean, where does Facebook have any hardware other than that virtual reality glasses thing that I don't think anyone bought?
Yeah, look, I think it just goes to show that Meta obviously is dependent on these app stores for their apps to be successful, and they are they have three of the most popular apps on both Android and iOS app stores. So anytime Apple or Google makes a change, that is where they got impacted with the IDFA changes. And look, that's what they want to avoid the next time it happens, given every, of the software vendors is trying to infuse AI, LLMs at the operating system level. So what does that mean for a company like Meta, which has its own LLM and wants to deploy it across more places? So owning the hardware does have some potential over there.
I've upgraded to the pro model of ChatGPT now.
Oh yeah, how's that working for you?
I'm paying for it. Well, I kept getting cut off because I was asking too many questions. But I use it a lot.
Really? How much do you pay?
$20 a month.
Sure.
Yeah, and it's pretty sweet. But I wonder if it costs less to develop and run a large language model than we thought. I realize it's a couple days old, this story, or a couple weeks, but I haven't got your take, Mandeep. Is DeepSeek full of it? I mean, were they just using illegally procured Hopper chips or Blackwell chips, or did they really make an LLM with $6 million?
Look, that was their last training run. That wasn't inclusive of all their training costs. But the bigger thing here is Apple, partnering with Alibaba to deploy LLM on their phone. And that's part of Apple Intelligence. So to me, it's not just DeepSeek anymore. All the other companies over there in China, whether it's Alibaba or, the other ones, Baidu, et cetera, they all have their LLMs. They may not be as capable as DeepSeek, but this thing is getting commoditized, in my view, given every LLM provider is improving their reasoning capabilities. And now Apple partnering, I think that's a big step in terms of deploying their technology. And Apple, I think, did note at their last earnings call that Apple Intelligence was a big driver of refreshes wherever it was available.
All right, well, Alibaba is up 3% today. It's hitting a 52-week high, still below its all-time high from back in 2020, but it's up 68% over the trailing 12 months, so certainly getting some love there. Mandeep Singh, thanks so much for joining us. Mandeep Singh, he's a senior technology analyst for Bloomberg Intelligence.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Isabelle Lee sitting in for Alex Steele. I'm Paul Sweeney. We are live in the Bloomberg Interactive Broker Studio in New York City. Streaming live on YouTube, so head over to youtube.com. That's the internet thing. Search Bloomberg Podcast now, and that's where you will find us. All right, I've been in this business since 1986, and since then, in my mind, Morgan Stanley has been the dominant franchise when it comes to all things real estate finance. And they still are today. Everywhere you go in the supply chain in terms of real estate finance, you're going to find ex-Morgan Stanley people. So we're really appreciative to have our next guest, Lauren Hochfelder. She's the co-CEO of Morgan Stanley Real Estate Investing. She joins us here in our Bloomberg Interactive Broker Studio. When I talk about commercial real estate, I think the first lesson I learned is don't just think about office space, because there's so much other stuff out there. Where are you guys at Morgan Stanley seeing the best opportunities today?
Yeah, so we start with what's driving demand, and so we invest behind long-term mega trends. Trends we're focused on today are e-commerce, the supply chain realignment, aging demographics. So where does that bring us? That brings us to industrial warehouses. That brings us to senior living, places that are really going to be propelled not by cyclical up and downs, but by these long-term trends.
Which do you see is leading right now? Because we've seen a huge shift in commercial real estate. Some people have said it's bottomed, but what are your views on that?
Well, look, commercial real estate or private real estate values in the U.S. are down, 25+% over the last 2.5 years, while the equity markets are up 60+% over the same period. We feel really good about the entry point to a lot of real estate today. We think that, we've seen a bottom start to form. Liquidity increasing, transaction volume increasing, cost of capital really coming in, spreads compressing. So we really feel like 24 was about moderation. 25, 26, we may see the transition into an upcycle.
All right, well, we got you here. Let's get an informed opinion. Commercial, office, real estate, New York, San Francisco, Chicago, Boston. Have we seen the bottom of that? I can't remember seeing too many transactions out there that would suggest we've seen the bottom. I don't know.
Divergence.
Okay.
So I think for the best of the best, we probably
731 Lexington Avenue. Best of the best.
Absolutely. For the best of the best, you are seeing not just resilience from some of the headwinds, but actually the best of the best assets are benefiting from what's going on right now. Massive consolidation into these top tier buildings. They've become like an oasis in the office desert. Everyone only wants to be in these assets. And so yes, you're seeing leasing pick up. in our San Francisco office assets, we are commanding all-time high rents, signing long-term, high-quality leases at way above pre-COVID. That's stunning when the market's almost 40% vacant.
Wow. So what happens to that 40%? Is it just have to find a bottom somewhere?
So, look, I think, yes, you're going to have some conversions to alternative uses. There are major complexities with that, both sort of zoning wise and physical construction wise. Some of it will get converted. A lot of it's just going to be cost prohibitive to really release in a meaningful way. You have to retrofit for sustainability conditions and amenitization. Demand has changed what it wants.
Apart from the example you gave, uncertainty still lingers. We have investors still cautious about jumping in. What do you tell them, or how do you convince them?
Look, it depends where. There are certainly areas I would not jump in, but when you look across the globe, for example, we find the U.S. to be the most interesting market in which to invest today. The U.S. is always FIFO, right? First in, first out. It's corrected the sharpest. It tends to rebound the quickest. So this is a market for the right sectors, for things like senior housing, industrial, certain other spaces. We find it really compelling. There are other parts of the world and frankly other sectors that we don't think have bottomed yet. For those lower quality assets, you still have a wall of maturities that's coming, and don't mistake delaying with fixing the problem. There's still some pain to come there.
Talk to us about the capital markets, the financing for real estate. If you want to go buy a building, do whatever you want to do in your real estate portfolio, where do you get the capital?
So debt capital is absolutely coming back. So we saw a period of time where there was just total illiquidity. We've seen CMBS pick up very materially. And we've seen spreads compress very materially. So of course, base rates are moving around maybe more than we'd all like, but spreads have compressed. So you're seeing a return to from some of the balance sheet lenders. You're seeing CMBS, and you're seeing really this massive rise in non-bank lenders. So these alternative asset management,
private credit,
okay. Private real estate credit.
Interesting.
You mentioned that 2025 or 2026 may be the year of reckoning. There was a big Bloomberg piece late last year around November, quoting a lot of people saying that, yes, 2025 will be our year. But in hindsight, that may look like wishful thinking, especially with the rates still elevated. How are you squaring your thoughts on that?
Absolutely. Well, look, we think this cycle is not going to be about rate compression. So coming out of the GFC, one of the ways we all did very well is, rates fell, you had cheap debt, you had cap rate compression. That was how a lot of appreciation was created. We think this cycle is different. So we do expect to see moderation in rates, perhaps a bumpy road down, but ultimately that's not what we're betting on. We think this cycle is much more about cash flow growth. And so what that means is you need to be in those sectors that have those mega trends driving demand, and in those sectors where supply has just fallen off a cliff. That's how you get cash flow growth, and frankly, owning assets that you can really improve. So not just buy and hold, but buy and change.
If you had the chance to buy a B-level building on 3rd Avenue on 48th Street at 50 cents on the dollar, would you buy it?
It really depends. So I think what people people tend to homogenize real estate. And I think there's a big difference between a 40,000 square foot floor plate and a 20,000 square foot floor plate in terms of what it wants to be and what its sort of highest and best use is. So it's just, you need to think about how that specific asset, B isn't the same, it's not B is B is B.
Okay. How about right across the street, can you lease out some of that commercial space? Because it hasn't been leased since the pandemic. I don't know what's going on there. So that's commercial real estate. I don't know, across the street from us, still after the pandemic.
That was the Victoria's Secret across the street.
Nothing. I don't know what's going on there. But Lauren, thank you so much for joining us. Lauren Hochfelder. She is the co-CEO of Morgan Stanley Real Estate Investing, joining us live here in our Bloomberg Interactive Broker Studio.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
lot of tariffs talk around the fireplace these days. That seems to be the economic policy of choice for President Trump and his administration. So industries around the world are trying to figure out what impact it will have on their business, and that includes the luxury business. Rania Sedhom joins us. She's managing partner at Sedom Law Group. Rania, when you think about the luxury business, high-priced items, by and large, different price points, different types of consumers. But again, if they're going to be subject to tariffs, whether it's from Mexico or China or anywhere, how does that play out in the luxury business?
I'm not sure it's going to bode very well for the luxury business. I mean, there is some stagnation already with consumers purchasing luxury. For the top 1%, none of these tariffs will really have an effect on their purchasing power. But there are a lot of Henrys out there, which are high earners, not rich yet. And they may pause if they have to spend an extra 10 to 25% on the same item.
Henry's, I had to explain that to my parents.
I just heard it for the first time here.
It's a thing.
All right.
High earners, but not rich yet.
Okay.
So
yes, it is a thing.
Which industry in the luxury sector will be hardest hit, though?
I think probably the fast fashion will be the hardest hit. I mean, right now, the tariffs that are going to be imposed on China are not just a regular 10% tariff, but there's also a loophole which currently allows fast fashion retailers from China, like Shein, that probably is one of the top ones that come to mind, allows them to ship products to the United States tax-free if the total sale is less than $800. And if that goes away, I'm sure that industry will be hit very hard.
So I think a lot of retailers, Rania, are trying to think about their strategy about to what extent can they pass increased tariff costs along to their consumers, or how that gets absorbed within the supply chain. What are the luxury companies thinking about? How much can they pass through to their consumers?
Well, I mean, as of January, a lot of the luxury retailers have already increased their prices by as much as 10%. And consumers are used to increases every January from luxury, good makers. However, I'm not sure if you tack on another 10 or 25% that they'll stick around. I mean, I'm worried about, Canada Goose, for example, as the name implies, it's from Canada. They're very expensive jackets. They're great jackets, but who's going to pay an extra 25% or more? It's unclear. So I'm not sure if all of the tariffs can be really pushed down at the consumer level. I think there's going to be some pain sharing here, but that's just my opinion.
Where do you think consumers will shift their attention to? We have some analysts saying maybe emerging markets like India or the Middle East. Is that what you're seeing as well?
Well, since about, I think, 2019, a lot of companies that rely heavily on China were starting to diversify. And right now, Vietnam and Bangladesh are like second and third in line. But yes, I do see some additional diversification coming.
Secondary market, circular costs. For the luxury business, secondary market's material. How is that going to be impacted?
Yes, I think it's going to really change everything about the secondary market. I mean, if you try to purchase a handbag, which is, one of the main, goods that people are looking for, bargains for, because not everyone has $12,000 or something to spend on a handbag. They go to places like eBay, and a lot of individuals selling on eBay are international. And if there's a tariff, likely, if you're not paying attention, your bag or whatever good you're buying is going to be held up in customs awaiting a payment. And for those consumers who are paying attention to how much the tariff could be, they may be dissuaded from purchasing, at least online. Then you have, secondary good providers that are local in some places, like, the Real or Fashion File. You can go into the store. But again, depending on where the item came from, people may be dissuaded. They just may not have enough money to spend an extra 10, 25, or whatever the percentages end up being.
On the part of the company, what do you think about the strategy of shifting some production to the U.S.? I mean, this would allow brands to avoid tariffs entirely or maybe cut costs. For instance, energy prices in the U.S. are significantly lower than in Europe. So maybe that would be one thing.
I think it really depends upon what good we're talking about. So, for example, the beauty industry, it is heavily reliant on packaging. Many people may not know, but oftentimes the formulas are pretty much identical from brand to brand. And what you're really paying for is the packaging. And of course, the color. People do have unique colors, and there are so many reds, I'm sure anyone trying to purchase red lipstick has gotten the experience that they had to try on 30 of them before they found the perfect red. However, it's the packaging and the molds. The creation of the molds is very expensive. So I don't know, for example, if the beauty industry will be able to pivot to US made immediately. It might cost too much.
Right. All right, Rania, thank you so much for joining us. Rania Sedhom, she's managing partner at Sedom Law Group as well.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.